What are the temporary changes to pension drawdown rates from the Covid-19 health crisis? Welcome to Q&AMP Understanding Retirement series, focused on superannuation and retirement. My name is Diana Mousina and I'm a senior economist at AMP Capital. The Covid-19 health crisis is creating a lot of changes to superannuation and retirement in Australia. My colleagues and I are here to answer some of your most frequently asked questions, and our plan is to tackle one question at a time. Today I'm joined by Technical Services Manager Fabian Bussoletti, who will talk us through the government's temporary changes to minimum pension payment rules. First up, Fabian, can you give us a bit of background?
Thanks, Diana. Well, under normal circumstances, anyone with an account-based or allocated pension is required to take a minimum amount of income each year as an income payment. The minimum amount is one that's calculated at the start of each financial year, and it's broadly based on your account balance and your age at that time.
And how has this changed with the current health crisis?
In response to the current crisis, the government has announced that this minimum drawdown requirement will be temporarily halved. What that means is that the amount of income that needs to be withdrawn for the 2019-20 and 2020-21 financial years has been reduced as a result. So, for example, someone aged 65 to 74 would usually be required to withdraw 5% of their account balance each year. However, as a result of this temporary measure, they will now only be required to withdraw 2.5%. This measure will apply both for the current 2019-2020 financial year as well as the 2020-21 financial year.
What are the benefits of these changes for people who have a pension account?
If an individual's lifestyle circumstances enable them to draw a lower level of income from their account-based pension, this will help to preserve their account balance during this time of crisis, as well as reduce the need to sell assets during a time of falling markets.
And what will this change mean for people who are receiving an income payment during the current financial year?
People who continue to need the income or who simply don't want to change their income payments for this current financial year can leave things as normal. For some people who may have already received the new reduced minimum amount for this financial year, they will have the choice to cease future pension payments altogether for the remainder of this financial year.
What will this change mean for pension payments next financial year?
It's important for people to check what their super fund is doing to implement this change. As super funds need to ensure that at least a minimum pension amount is paid each year, for those people who have chosen to receive the minimum amount, from 1 July 2020, some providers may automatically start paying people based on the reduced minimum amount. And this could result in a significant reduction to their annual income amounts if left unchanged. So you might need to let your super fund or your financial advisor know if you want to receive an amount higher than this reduced minimum pension amount and specify the amount that you wish to receive.
If a person still needs the same level of income next financial year, should they simply specify this amount and let their fund know?
Once again, it depends on their personal circumstances. For example, for some people, there may be benefits in reducing the amount that they receive in the form of pension payment amounts down to the new reduced minimum requirement and replacing the additional income with a lump sum withdrawal instead. But to make that decision, people will need to assess their individual situation and their income needs. It might also be a good idea to seek out some professional advice.
Does this apply to other types of pensions as well?
These changes apply to account-based or allocated pensions, but they also apply to transition to retirement income streams and also to market-linked income streams, sometimes referred to as term allocated pensions.
For those wanting to take advantages of these changes, what should they do?
For the current financial year, they should keep an eye out for communications from their super fund advising them on how to reduce their pension payments if they wish to do so. But it's also important that they look ahead to the 2020-21 financial year to make sure they review their future income needs and plan accordingly.
Thanks, Fabian. Plenty of detail in there. Let's do a quick recap. Those who hold account-based pensions must withdraw a minimum amount each year as income payments. This income payment has been temporarily halved because of the Covid-19 health crisis, and this will start from the 2019-20 and the 2020-21 financial years. Reducing the amount of income received from these pensions should help to preserve pension account balances and also reduces the need to sell assets in a falling market. This legislative change means that those who have elected to receive the minimum amount will have their elected amount temporarily halved from the 1st of July 2020. If you are impacted, you should keep an eye out for more communication from your super fund.